Hey, what's going on, guys? Today, I wanted to share a few strategies that have helped me in the past when it comes to hedging my bets and reducing the drawdown of my portfolio. So, this video will focus on strategies that would not require leverage or would not require you having to actively short the market, right? So, let's take a look here. A first way to actually hedge your bet is to realize that the market condition could be oversold or overbought over time, right? And then we want to kind of position ourselves around that and get the best risk and reward possible. One of the most simple ways to hedge your portfolio is to simply add some stablecoin to your portfolio. And the reason is quite simple, right? Let's say you have a 100K portfolio, you have 50K into different assets like Bitcoin, Ethereum, Solana, and maybe some other altcoins. And then let's just say you have 50% of stable coins. And let's say the crypto market goes down by 50%, then your entire portfolio is going to be only going down by around 25% because you have a 50% stablecoin allocation, right? That makes a lot of sense when the market is quite overheated. A lot of assets seems to be overbought. Then you want to kind of adjust your long exposure to be less long, right? And if you're a longer term investor, we could use other diversification strategy by just staying long here in the crypto market, but then maybe diversifying our holdings. We'll talk about that next. But in this stage, if you just want to focus on crypto, for example, or you have a larger allocation to crypto, it could be very helpful to have some stablecoin allocation. I like to keep my stablecoin allocation between anywhere from 10% all the way to 50%. I personally don't like to be too heavily into stablecoins just in case the market just keeps drifting higher. I want to actually have some longer term exposure, right? Because I'm investing into crypto for the next 5 to 15 years. I'm not looking to like make $1 million by next year, right? I personally really like this risk dialing strategy where I'm still net long over time, even if I'm taking profit more aggressively when prices are high, right? If you guys are yield farming, it does make sense to be using your fees smartly, where like if prices are quite low, you could focus on compounding your fees into more crypto assets. And then when the prices are high, we could be de-risking more of our fees into more stable coins, right? That's one of my favorite strategies. And then also potentially closing out some of the positions into stable coins if we don't want to use leverage when it comes to hedging our bets. Because if you are less long when the market is more overheated, then you're hedging against the fact that the market could shift from being overbought to being oversold. And a lot of beginners make the mistake of dialing the risk too aggressively. A lot of people, for example, lend out their ETH, their Bitcoin, and then borrow stablecoin against it to yield farm stuff like ETH to USDC or Bitcoin to USDC. You're technically leveraged long here, right? But the problem is, if you are wrong about the market drifting up in price, you could lose a ton of money in the process. I've seen a lot of people just message me or leave comments in the YouTube videos saying that, okay, they're stuck, right? They're stuck because they took on leverage when the market is already kind of overbought. And then they're using that USDC to yield farm ETH to USDC, right? And then maybe because the range was too tight, their pulls are out of range. They're not making that much cash flow. And then they're also in the danger of being liquidated. What we have to realize is that if we are leveraged long, we will make more money if prices move up, but at the same time, we will lose money when the prices go down, right? There's always a trade-off when you guys are looking at different strategies. Like for example, even this risk dialing method, where we're switching from long to less long, we are giving up some of the upside, right? And that is completely okay, depending on your own risk tolerance. If your portfolio is still outpacing inflation, you're still making like at least 10% return, let's say over the long term, that's still a pretty good portfolio compared to losing your entire portfolio or a big chunk of it based on using too much leverage, right? So we really want to be careful with this strategy here. A lot of traders do this, right? They switch from leverage long, and then during the overheated period, they're using like a leverage short. And in my opinion, this is not as good of a strategy. The reason why is I've seen it time and time again where people are wrong about the market, where they might be delta neutral or leaning net short, and then they're forced to hold those short for a very long period of time and potentially risk the liquidation of their entire portfolio. So this is a very helpful concept. of taking more profits and then adding stable coins to your portfolio could be a way to hedge the downside risk, right? So that's a very simple way to hedge. And then let's talk about diversification next. Diversification, in my opinion, is just much more important than like any investment strategy that I could share with you or any yield farming strategy that I could share with you. This should be obvious, but a lot of people still don't do it or just they don't understand how to diversify properly. So this is one of my favorite way to diversify. This is from Ray Dalio, a famous hedge fund manager. And basically what we are looking to do is we add more different asset classes, right? If we are buying stuff like gold, stocks, real estate, and then some Bitcoin, and maybe we're yield farming some stablecoin protocols or different protocols that is generating a yield and is not correlated to the crypto market. For example, I have been sharing some yield bearing assets with the Drippy community on the OnRe and Re. They do reinsurance, and you guys can look it up or just let me know in the comments if you want to learn more about that. But basically, they provide capital to insurance companies and then you earn the yield in the process, right? So that's another way to actually diversify your portfolio. If we look at it here, basically, if you could introduce some zero correlation asset into your portfolio, then it's going to reduce the deviation of your portfolio by quite a huge amount, right? The standard deviation is the volatility of your portfolio. But what is even more important is that it reduces the probability of losing money in a given year. So my altcoin portfolio hasn't been doing that well throughout 2025 because the asset and the market is just kind of weak, right? But thankfully, I have some exposure into stuff like REITs and different ETFs of the stock market. Then I actually made a pretty decent return because I have these other asset classes, right? And I also have some stable coins. One of my biggest losses is not from actually investing, it's from like actually getting scammed. So this concept really helped me. And one of the major benefit from diversification is not really the returns that you could get also is from that peace of mind, right? Because if you put everything into crypto, into Bitcoin, into altcoins, I've seen people like just go all in and then their portfolio gets cut into half or more. And then basically they lost a ton of money. And some of it is like their life savings, right? So it's really dangerous, in my opinion, to like actually put all of your eggs into one basket, especially if you have much more capital or you're using money that you've earned for like years to put into the market, right? But if you are just starting out and you have a little bit of money to invest, it could make more sense to concentrate your bet just a little bit. But in my opinion, it's much better to just start diversifying early on so that you build that habit and that you don't overexpose yourself to a specific market, right? And if we look at diversification also in one asset class, if we're buying stuff like stocks or if we're buying different crypto asset, you are going to find that if you add more assets to your portfolio, the risk of your portfolio is going to kind of drop to match the market risk because you're no longer reliant on one project to succeed. You're relying on the entire market. And, if the market is bad, then of course you will still lose money. This is another concept that you could apply. This is really important, especially if you guys are buying altcoins. If you go too heavy into one altcoin, then if that altcoin doesn't do well, then your portfolio is going to be at risk, right? This is one of the major mistakes that I've made as well, is that I just put too much capital into one investment. Even though I believe in the investment, we never know the future. The market is changing all the time. The competitive landscape is changing all the time. So there's a lot of moving dynamics that we have to consider when we're actually actively investing or picking out our investment. And this doesn't really mean that you should be like, for example, if you have like 100K crypto portfolio, you just put a grand each into like 100 different assets, right? It doesn't really mean that because it does make sense to have a larger allocation to stuff like Bitcoin, Ethereum, or some other majors like Solana, BNB, Hype. But let's just say you're allocating like 20% or 10% of your crypto portfolio into these different altcoins. It does make sense to kind of spread out your bet into like maybe 3 to 5 different altcoins versus like going all in into one, right? So this is a concept that has helped me a lot too. And another concept that has helped me a lot is the strategy diversification concept, right? So if you are trying to make money from the market, a lot of times to get a smoother equity curve, you kind of need to combine different strategies. Maybe you're combining options, you're combining buy and hold, maybe you're dollar cost averaging, or you're providing liquidity with altcoins, you're doing some short hedging, or you're just running a job or a business, or you're doing some swing trading. It's going to have a much smoother equity curve versus like relying on one strategy, right? For example, if you guys are yield farming a lot of tight ranges, you're doing a lot of active liquidity, those type of strategies typically do much better in like low volatility environment or on like specific tokens. There's a lot of tokens that are lower market cap and then maybe the fees are higher, the prices are not moving much. Maybe you could be earning more from those strategies, but at the same time, if you just have that one strategy, but then the market does not move into your favor, you're not going to have a very smooth equity curve, right? For me personally, I'm combining a lot of just dollar cost averaging into stocks and then some buy and hold and altcoin LPs. And then I'm also actively working on Drippy, which is my business here, right? We're building software and the community and the education to help a lot of liquidity providers and investors. In my opinion, there's a ton of misinformation out there and it just could cause a ton of losses. I've seen people paid a ton of money for like coaching and stuff like that, but then they're running strategies that ultimately lost them a ton of money. But the main point here is if you have a more diversified strategy, it's going to kind of reduce the risk of your portfolio. And if you're just having a small portfolio, then you don't really want to spend too much time managing your positions, right? If you kind of read here, you can only kind of be good at like 1 to 2 different active income strategies, especially if you guys already have a job. It doesn't really make sense at all to be like doing a lot of active liquidity provision. This is especially true if you have a smaller portfolio. The reason why is if you kind of just double down on your job or your business, you don't have to take as much risk and you could probably make more than actually trying to do too many things at once, right? This is why I really like wider range liquidity and strategies that are much more passive. I only have to spend like 1 to 2 hours per month to manage my positions. So I don't really need to do much management at all. And even if I leave it for like 3 to 6 months, my investments are still going to be there. I don't need to make too much adjustment. But the idea here is you want to kind of have multiple strategies running. And because a lot of times we never know what's going to happen in the market, right? Altcoins could be doing not too hot, and then like your stocks could be doing really well. And if the market is trending up too aggressively, then maybe some of your LPs are not going to be as optimal than just buying and holding, right? So it's really important to have a more diversified strategy. So that's pretty much it for this main video here. If you have more stablecoin allocation and non-correlated assets, if you're adding stuff like gold, stocks, real estate, maybe some bonds too, if you are nearing retirement age, right? That this is going to give you much more resilience when it comes to protecting your portfolio from a market drawdown versus going all in into one asset class. And if you're actively investing, it does help a ton to have your risk more spread out, right? It doesn't make sense to like put all of your asset into one thing, especially because if you really need that money. And a lot of times we hear of investors that basically went all in and then made a ton of money in the process. Those are typically outliers. There's just a ton of investments that don't work out, right? So we got to keep that in mind. And that could be like a survivorship bias. And lastly, we could think about some strategy diversification so that we can have a smoother equity curve when it comes to managing our portfolio, right? And this is what I'm trying to get better at as well. I don't want to concentrate my risk too much into like different altcoins. I just want to have like more blue chip strategies and then just staying consistent with stuff like dollar cost averaging, index funds, and stuff like that. So I hope that was helpful. And the main reason why I made this video is that you don't really need to do stuff like shorting or buy like protected puts if it's too complex for you to actually protect your portfolio, right? And sometimes when the prices are kind of like near the middle of the range, it doesn't really make sense to be like hedging your bets that way anyway. Because if you are looking at charts like ETH, and you believe that the prices are kind of already pretty cheap or you're happy to buy, then it doesn't make sense at all to be heavily shorting this chart, right? And especially if you're just starting out with investing or with crypto, it's really important to know all of these before you do stuff like short hedging with perps. Because in my opinion, it's just much easier to lose money if you don't know what you're doing when it comes to hedging with perps. Hopefully this video was helpful. Thank you once again for watching. I'll catch you on the next one.